Welcome to the presentation on company law, accounts and audit. This session will provide a comprehensive understanding of the legal requirements and processes involved in company accounts and audits. Here's an overview of what we'll cover today. Company law overview, books of accounts, annual accounts, director's report, audit process, and auditor's rights. Let's dive into each section for a detailed understanding. We begin with an overview of company law, setting the stage for understanding the legal framework governing company accounts and audits. Understanding the importance of financial reporting, legal compliance, and directors' responsibilities is crucial. Importance of financial reporting. Financial reporting is essential for presenting a clear and accurate picture of a company's financial status. It serves as a basis for stakeholders, including investors and creditors, to make informed decisions regarding their involvement with the company. Legal compliance. Companies must adhere to established legal frameworks governing financial reporting. Compliance fosters trust and credibility, ensuring that financial statements are prepared following accounting principles and legal stipulations. Directors' responsibilities. Directors are vital in managing company finances and ensuring compliance with legal reporting standards. They must maintain oversight of financial operations and prepare truthful reports reflecting the company's performance and integrity. Transparency in financial reporting is vital for shareholders, government entities, and employees. Importance for shareholders. Transparency in financial reporting is crucial for shareholders as it provides them with the necessary information to assess the company's profitability and risks, enabling better investment decisions and fostering shareholder confidence. Role of government entities. Government entities depend on accurate financial records to regulate the corporate sector effectively, ensuring that companies comply with tax obligations and maintain fair practices within the market. Protection of employees. Employees also benefit from transparent financial practices, as reliable financial reporting can lead to job security and opportunities for growth, reflecting the overall health of the company and its potential for investment in human resources. Next, we explore the books of accounts, which are essential for maintaining accurate financial records and ensuring accountability. Companies must legally maintain comprehensive records of all financial activities. This includes various types of records and ensuring their integrity to prevent misrepresentation. Legal mandate for record keeping. The law mandates that companies maintain comprehensive records of all financial activities to demonstrate accountability and ensure stakeholders have access to relevant information as required by various regulations. Types of records maintained. Companies are required to maintain a variety of records, including transaction logs, ledgers, and financial statements, regardless of whether these records are kept manually or through computerized systems that enhance accuracy and accessibility. Integrity of financial records. Maintaining the integrity of financial records is paramount. All records must be accurate and reflect the company's true financial status to prevent misrepresentations that could mislead stakeholders. It's important to know how long to preserve records, where to store them, and how to maintain branch office records. These practices ensure historical data is available for audits and compliance. Record preservation period. Companies must preserve their books of accounts for at least 10 years. This requirement ensures that historical financial data is available for audits and governmental reviews, contributing to corporate transparency. Location of record storage. Generally, records should be kept at the company's registered office. However, directors have the authority to store them elsewhere, provided proper documentation and resolutions are submitted to the relevant authorities. Branch office record maintenance. Companies with branch offices must maintain necessary records at those locations, with summaries sent to the headquarters, ensuring that the main office is informed of each branch's financial activities and obligations. Inspection rights. Directors' access to records. Directors are entitled to inspect the company's books of accounts during standard business hours, allowing them to monitor financial accuracy and compliance effectively. thus safeguarding stakeholder interests. Regulations on foreign records. Should any records be maintained outside the country, companies must ensure that copies are readily accessible for inspection by directors. This provision reinforces the importance of transparency and accountability across borders. Now, let's discuss annual accounts, which are crucial for presenting a company's financial performance over the year. Financial statements must be presented at general meetings, undergo audits, and be submitted within specific timelines. This ensures accuracy and transparency in financial reporting. General meeting requirements. Financial statements must be presented at a general meeting of the company's directors, ensuring members are informed and can deliberate on the company's financial performance and strategy. Audit requirement details. The law mandates that financial statements undergo an audit to verify their accuracy before their presentation, providing assurance to stakeholders about the integrity of reported financial data. Timeline for financial statements. Newly incorporated companies must present their first financial statements within 16 months, followed by subsequent statements within 4 months after the financial year end, ensuring timely transparency. Listed companies must submit financial statements to regulatory authorities, while private companies may have certain exemptions. This ensures accountability and compliance with legal standards. Regulatory filings for listed companies. Listed companies are required to submit multiple copies of their financial statements and accompanying reports to regulatory authorities and stock exchanges, promoting accountability and transparency in public trading. Submission of financial statements. All companies must file their adopted financial statements with the registrar within 30 days of the annual general meeting to ensure that accurate financial records are available for public scrutiny and regulatory purposes. Exemptions for private companies. Certain private companies, based on capital thresholds, may qualify for exemptions from specific filing and audit requirements, allowing them to retain operational flexibility while still adhering to essential compliance standards. The director's report provides insights into company performance, required disclosures, and business review requirements, ensuring stakeholders are well informed. The report includes financial results, operational activities, and future strategies. It must also disclose essential information and provide a business review for listed companies. Insights into company performance. The director's report provides a comprehensive overview of the company's performance, offering insights into financial results, operational achievements, and future strategic directions for informed stakeholder engagement. Required disclosures. The report must include essential disclosures related to dividend proposals, any changes affecting the financial position, and material events, thereby ensuring that stakeholders have a clear understanding of the company's status and plans. Business review requirements. For listed companies, a robust business review is obligatory, addressing trends, risks, and corporate social responsibility efforts. This transparency supports ethical governance and stakeholder awareness. The director's report requires board approval and signatures, ensuring accountability. Smaller companies may have exemptions to streamline the process while maintaining transparency. Board approval and signatures. The director's report requires prior board approval and must be signed by the CEO and at least one director. This process reinforces accountability and the authenticity of the information provided to stakeholders. Exemptions for smaller companies. Smaller private companies may be granted certain exemptions regarding compliance statements and reporting formats, allowing them to streamline processes while still maintaining basic transparency standards. Next, we delve into the audit process, which is essential for verifying the accuracy of financial statements and ensuring compliance. Appointment of auditors. Timeline for appointment. The company must appoint an auditor within 90 days of incorporation, establishing a critical timeline for ensuring effective oversight of financial practices from the outset of its operations. Notification procedures. Proper notification procedures are established for informing stakeholders about proposed auditor appointments during the annual general meeting, ensuring transparency in the selection process. Directors' responsibilities. Directors are responsible for determining the remuneration of the appointed auditors, ensuring that the auditing process is adequately supported while maintaining independence and objectivity from the company's operations. Auditors must meet specific qualifications to ensure they can conduct thorough assessments. Disqualification criteria prevent conflicts of interest, maintaining the integrity of the audit. Auditor qualifications. Auditors must meet specific qualifications, including being registered chartered accountants. These requirements ensure that auditors possess the necessary expertise to conduct thorough financial assessments. Disqualifications and conflicts of interest. Disqualification criteria are in place to prevent conflicts of interest, including particular relationships with company directors or indebtedness to the company, thereby ensuring the independence and objectivity of the audit process. Finally, we discuss the rights of auditors, which include access to company records and the ability to request information from stakeholders to perform accurate and independent audits. Auditors have the right to access all necessary company records and request information from stakeholders. This ensures comprehensive and independent auditing, maintaining financial integrity. Rights to company documentation. Auditors hold essential rights to access all company records, accounts, and vouchers necessary for performing their audits, ensuring a thorough evaluation of the company's financial conditions and compliance integrity. Information requests from stakeholders. They may also request information from directors, employees, and relevant parties, reinforcing the collaborative obligation to provide comprehensive data essential for accurate and independent auditing. Auditor's report. Opinion on financial statements. The auditor's report must articulate an independent opinion on the financial statements, confirming compliance with legal requirements and whether they present a true and fair view of the company's financial health. Compliance and fair view statements. The auditor's assessment includes comments on the overall compliance with applicable laws and regulations, solidifying the report's role as a trustworthy source for stakeholders evaluating the company's financial practices. Disclosure of limitations. Should there be any limitations in the provided information, auditors are required to disclose these in their reports, alongside clear articulation of any reservations or qualifications, drawing attention to potential risks. In conclusion, the importance of transparency, accountability, and ethical standards in corporate governance cannot be overstated. These principles are essential for maintaining stakeholder trust and ensuring the long-term success of any organization. Transparency and accountability are vital in corporate governance. Role of regulations in corporate governance. Regulatory frameworks serve as foundational elements in corporate governance, guaranteeing that companies maintain transparency and uphold accountability, which are essential for building trust with stakeholders. Benefits to stakeholders. The adherence to financial regulations benefits all stakeholders by ensuring the availability of accurate financial information, promoting informed decision-making and fostering an atmosphere of trust and collaboration within the business community. Upholding ethical standards is fundamental in independent auditing. Importance of independent auditing. Independent auditing is critical for assessing a company's financial health objectively. It provides assurance to stakeholders that the financial statements are free from errors and misrepresentations, enhancing the company's credibility. Commitment to sound financial practices. A commitment to sound financial practices reflects a company's dedication to ethical behavior and accountability, further solidifying its reputation and fostering long-term relationships with stakeholders built on trust and reliability. Thank you for your attention. For any further queries or information, please feel free to reach out to the course facilitator or comment below.